So this is chapter number 14, gearing and capital structure. Gearing means the ratio between the equity and debt. So how you see, you know that your capital, it consists of equity and debt. So probably you have, you know, 600,000 in equity, 400,000 in debt, total capital is 1 million. So out of 1 million, 600 equity, 400 debt, you call it a capital structure of 60-40. 60-40 means 60% equity and 40% debt. And this is called a geared up company because there is some leverage. Gearing and leverage are the same words. So gearing means the presence of debt within a business. It's not 100% equity financed. When you say 100% equity financed, it means that you don't have debt. All of the money is contributed by the shareholders. But when you take money from outsiders in form of debt, like long-term loan or bonds, so now within your capital you have debt, and you can say that you have gearing. So you call it a geared up company. And if the debt is increasing, you say that gearing is increasing. And gearing, it increases the risk. And how it increases the risk, this is what we are going to see here. So we are talking about here only about financing decisions. How much debt finance? This is the question. How much debt you should take? You know that debt has two characteristics. One, that you have to pay back after some period of time. And number two, that you have to pay interest on that. And both of these conditions, they create risk for you because you have to pay a fixed interest rate. What if you do not have enough profits to pay interest? Then you will pay interest, you will go into losses. And second is that you have to return back the debt after some time. What if you don't have money to return back the debt? So you run into problems. I mean, you can go for bankruptcy in that case. So the more debt you take, the more risk you are taking on yourself. And that's the same principle in your personal life as well. In personal finance, the same thing happens. So identify and discuss the problem of high levels of gearing. Assess the impact of sources of finance. Sources of finance means equity finance or debt finance on balance sheet, financial position, and financial risk. And we call it financial risk, by the way. Ratio analysis, cash flow forecasting, effect on shareholder wealth, etc. These are the topics which we are going to discuss. So key models and theories, gearing and how it contributes to risk, and how does your gearing, it increases your risk. We will see that. And finance for small and medium-sized enterprises we'll talk about. So gearing is the amount of debt finance a company uses relative to its equity finance. Debt finance is relatively low risk for the debt holder. For you, it has more risk, but who is giving you the debt, for them, it has less risk because their interest must be paid. You make profit, you don't make profit, they will get their interest. So they are secure. And the loan can be secured. Probably there is some mortgage there, there is some collateral there. And in case of liquidation, the debt ranks higher than the shares. So the bank who is giving you, I tell you, you should understand first of all. There is one basic question. I'll ask you people, I need your attention. I am the manager and I'm starting, you guys, you three people are the shareholders, you are the owners. And I'm running your business. I'm your manager. And I know that our company, it needs $1 million. I have two options for this new project. For this 1 million I need. One is that I come to you and I say, Farooq, Avilash, and Marisa, guys, we've got a new project and we need a $1 million. And I ask you people to contribute. If I'm asking you to contribute, it means I'm going for equity financing. Alternatively, you say that no, we don't have extra investment. Please go and do debt financing. So then I go to a bank and I ask the bank to give 1 million. In any case, me as a company, either I can take money from the shareholders, which is called equity, or I can take money from the bank, which is called debt. And in either case, the company has to pay something because when you guys will give this money, you will expect some dividends or some returns, some profits on the money which you are giving. It may not be promised, but there are some expectations. On equity, when you dividends, you don't have a promise for dividend, but you have expectations for dividend. Similarly, if I take $1 million from the bank would straight away ask, give me 8% or give me 10%. So there is a cost of equity and there is a cost of debt. Do you understand my point? I get debt, there is a cost, and that cost is called interest. I get equity 1 million, there is a cost, and that cost would be in form of dividends. So a business always tries to get resources at the lowest cost. Money is just like a resource. As a business manager, when I'm managing this business, I have to rent an office, and I know that office, it is a resource. And if I'm using some office, I have to pay some money for that. I have to pay rent. Then I want to use electricity. If I use electricity, I have to pay the bill for that. If I need some services of an accountant, I will hire one accountant and I have to pay him salary. So that is the cost of hiring the accountant. There is cost of using the electricity. There is cost of using the premises. So everything in the business has some cost. Now, this capital, which I'm getting in form of equity or debt, it also has a cost. Cost of using equity or cost of using debt. So when I get this, and just like as a manager, I always try to keep my cost lower. So I will see the office spaces and I will try to get an office with the lower rent, or probably I would negotiate on the rent. When I would hire an accountant, I will try to hire a person with the minimum salary who can do the job, or even I would try to negotiate with him on the salary because I want to decrease my cost. So any cost which I'm incurring, I'm trying to decrease my cost. Do you understand with me until here?
Yes, sir.
Now, I have two options. Either I can go and take 1 million from the equity shareholders, and I know I have to pay something, or I can go to the bank and take 1 million as debt, and I know I have to pay something to the bank as well. And I want to get cash from a source where my cost is less, where my cost is lower. I don't want to pay more. In either case, I have to pay. Either I would pay to the equity shareholders or I have to pay to the debt financiers. So I have to pay, but I want to pay minimum. As a business, it is my intention or it is my desire to pay as little as possible. So what do you think? For me as a manager, what is cheaper? Getting equity is cheaper or getting a debt is cheaper? Which has lower cost for a business? Yes, I need an answer from you people. Abhilash, what do you think? Equity for a business, equity is cheaper or debt is cheaper? No answer? Marisa?
That should be cheaper.
Huh?
That should be cheaper.
Debt should be cheaper. Why debt should be cheaper?
Because you know outright what the percentage will be when you sign up the contract with the debt holder. So you know exactly what you set out to pay. As opposed to the equity, you have to pay from the funds that you already have for the shareholders or the stakeholders.
Mm-hmm. Okay, let me redefine it. Your answer is correct that usually, I'm not saying the word always, but usually debt is cheaper. The reason is, for example, if I go to a bank, the bank would pay me money. I can get money from bank for at 8%, let's suppose, per year. But if I go for equity, it would be 10%. Equity shareholders would require more. Debt providers, they require less. They require less. Why? They are outsiders. But they need less. Shareholders are insiders, but they need more. Why? Because you have got that one principle in mind. You know that higher the risk, higher the return. Whoever takes more risk, he gets more returns. As the risk goes up, returns go up. That's the principle. The debt holders, they take very little risk because they set the interest rate at fixed amount. Give me 8%. You make more, you make less, I don't care, give me my 8%. Number one. And number two, they get collateral. They are not giving debt without any security. They give secured financing. So in case I don't pay, they will sell my asset and they will get their money back. So whereas equity shareholders, they are taking more risk because I do not promise with them. They may get more, they may get less, or they may not get at all any dividends. And about their investment, again, there is no security. If the project fails, if the company goes bankrupt, all of their money is lost. So equity shareholders, because they are facing higher risk, therefore equity, cost of equity is usually more than cost of debt. Now, this is the fundamental principle we should remember for our this chapter and next chapter. Now, I'm not saying it is always, but I'm saying that usually, most of the time, this will happen. That debt will be cheaper because debt is less risky for the financer. For me, it has more risk because I have to pay, interest. But for them, it is less risky because they get fixed rate of interest and they get a security in form of my asset. I don't pay money, they will sell my asset. So their risk is less. So therefore, they are willing to take 8%. They are happy with 8%. But equity shareholders would require more because they get more risk. Okay? So this is one point we just cleared, that debt finance is relatively low risk and therefore it is usually cheap. Debt is cheaper source of finance. So let's do one question. The companies are identical except for capital structure. This is called ungeared company. Ungeared company means that they don't have any debt. All money is financed by equity. It is a geared company. Geared company means they have some debt. So they make profit 1,000, 1,000, and then interest cost. Because it does not have any debt, so there is no interest cost. And it pays interest on the debt, 400. So profit after interest is 1,600. Then you pay tax 25%. So he pays 25% on 1,000 and he pays 25% on 600. If you see that tax is less here. Tax is less here because profit is less, because interest is a tax admissible expense. You write down expense, profits become less, and your tax also becomes less. So profit after tax is 1,000 minus 250, 750, and here you've got 450. You've got here equity 10,000, no debt. You've got here equity 6,000, debt 4,000. It is 60-40 ratio. Total capital is equal. Do you understand this financial situation? Now,
Yes,
what they ask us, they say that redraft their statement of profit or loss, assuming that operating profit increases by 500,000. So this is 1 million. So it will go to 1.5 million. Or operating profit halves. Half means that it is 1,000 or 1 million, it will become half a million. So you add 500,000, you subtract 500,000. Two scenarios we will make. So first we increase their operating profit with both of them and we will see what is happening. If you see that when I say operating profit increases by 500,000, it means there is a 50% change in the profit. I'm using the word 50% change. It goes 50% up, it goes 50% down. So this is what it looks like. You've got ungeared company and geared company, the same two scenarios. Operating profit, interest, profit after tax, tax, and profit after tax. Okay, profit after interest and profit after tax. Then you increase. You add 500 here and you add 500 here. When you add 500, so they don't have any interest. Their income is 15. They pay interest. They pay the tax 375 and their profit is 1125. Whereas this geared company, they still pay 400. Their profit is after interest 1100. They pay tax, it is 825. Now, if you see that this ungeared company, it moved from here to here. This is a movement of only 50%. Like profit changed by 50%. So we said operating profit, it changed by 50%. Net profit also changed by 50%. This goes up by 1000 to 1500. It is 50% change. Here it is also 50% change. But in ungeared company, your earnings, they go up by 50%, but your profit goes up by 83%. From 450 to 825, it means 83%, which means that in a geared company, whatever percentage you increased in operating profits, the same percentage happened in after tax. But in a geared company, there was a much bigger impact. 83% it went up. Now let's decrease it. So geared company, I decreased to 500, ungeared I decreased to 500, and then will we pay interest and taxes. So you pay attention that you were here at 750, you come down to 375, which is a 50% reduction. You become half. From 750, you made it half. From 1000 to 500, this also becomes half from 750 to 375. But on the geared company, this becomes half, 50%. But you see here, from 450, you come to 75. 83% you went down. So what it tells us that a geared company, because it is paying a fixed amount of interest, it is very much volatile in its movements. A 50% change in earning is causing an 83% going up or an 83% going down. And if you come down to only 400, you are in loss. If you come down to 400, you are zero. Actually, not in loss, but in zero. So this is the impact or effect of gearing on your earnings. Clear? Okay. Gearing or leverage. Gearing and leverage, they mean all the same. It's the same thing. Let me see here. I've got one friend here. So gearing or leverage, it is all the same. Gearing ratios, the financial risk of a company's capital structure can be measured by gearing ratio. You remember from F7, even from F3, you've got debt ratio, debt equity ratio, and interest coverage ratio. We'll see them. Financial gearing is prior charge capital over equity. So what is prior charge capital over equity? Prior charge capital means loans plus preference share capital. So this is actually debt, long-term debt. You can call it long-term debt over equity, or you can call it long-term debt over total capital employed, which means debt over equity plus debt. How would I write down this? If I have to make it simple, I would write it down like this one. I would prefer writing down like debt divided by debt plus equity. You can call it like this, okay? You can call it like this, debt divided by debt over equity. This is the same thing. Prior charge capital means debt. Total capital employed means debt plus equity. So you can use this symbol, even the easier way of doing it. And here you got financial gearing, prior charge capital over equity plus prior charge capital. Again, debt over debt plus equity. Okay, so these are the ratios which we do. Calculate the gearing ratio of this company. Use the first two ways. Which means that you say debt over equity or debt over equity plus debt. The one and two. Here it is debt over equity. Here it is debt over debt plus equity. So you've got ordinary shares. This is equity. Reserves equity. Preference share is debt. Debenture is debt. Long-term loan is debt. So these first two are equity and these three are the debt. So if I have to do equity plus debt over equity, I would say 5, 1, 15 and 23. 2300 divided by 500. So let's see how do they do it. Yeah, 2300. These are your prior charge capital, which means debt. Debt is 1, 2 and 3. These three items are debt items. These two are equity. So 2300 divided by 5000, it's 46%. Gearing ratio, debt over debt plus equity. Like I told you, debt over debt plus equity, 2300 divided by entire all of this, debt plus equity, all of that, 31.5%. Now, please, can somebody tell me what does that mean? If I say 46% debt over equity, what does that mean? Can somebody contribute? No? Farooq? So this 46%, it means that it is your debt in the business, which means that 46% of the assets of the business, they are financed through debt. Because on your balance sheet, if you remember that what do you have? You've got here your balance sheet structure where you have assets on this side, you've got here assets, and here on this side you have equity plus liabilities. So whatever assets you have, let's suppose your assets are, I don't know, $1,000 total assets, and here it means that 46% is debt, which means your debt here, the total debt is 460, and your equity is, in this case, is 540. This is what it means, and that's how you make it 1000. So it means that out of the total assets of 1000, 460 has been financed through debt. Not all of the assets are purchased by shareholder money. To acquire this $1,000 assets, shareholders, they only invested $540. Rest of the money, it came from the debt by the outsiders. So whatever are your assets, 46% is contributed by the debt, and 540, 54% is by equity. Am I clear? 46% means this. Okay, so you've got interest coverage ratio. You have interest coverage ratio. It means that what is your profit before interest and taxes, PBIT, divided by interest. So let's suppose your profit before interest and taxes is $10,000 and your interest is $1,000. So it means your ratio is 10. It means that your earnings are 10 times more than your interest. So you have to pay $1,000 interest, but your earnings are 10,000. You are pretty much safe. You can safely pay your interest cost. Which of the following businesses do you think could survive more easily on a low interest cover ratio? Low interest cover ratio. A construction company or an official office rental company? Of course, construction company cannot work with low interest cover ratio, because low interest cover ratio means that profits are less, profits are not as much more as interest there is. So you may have a volatility and you may have risk, because the cash flows are very erratic in this case. But office rental company can survive with low interest cover because they have, income very stable. They know exactly how much they are going to get, and from there they can pay easily their interest. Almost certainly, the office rental company would survive more easily. The construction company will probably have erratic income flows, whereas the rental company is likely to have more stable income from a portfolio of clients That will make it easier to pay the interest as it falls due. They have regular incomes. So they have regular income from the rent and they can pay their interest on a very stable. So even their income is less, but it is stable, they can still pay. But office construction, but this construction company, they may experience ups and downs in income. So they should be having a very high interest cover ratio to, you know, escape from any unforeseen things.